Jim Tierney is CIO of U.S. Concentrated Growth at AllianceBernstein. Jim, good to have you on the set.
Thanks for having me.
15%, two stocks. Does that worry you?
It certainly does. When we think about portfolio construction, we want to make sure that we have a diversified portfolio. With the top 2 or the top 10, which are both at all-time records, the concentration is scary, and it's all around AI. That said, those are the companies that have the earnings growth. And you came out of second quarter earnings, and every one of those companies beat substantially. So as long as the earnings are there, we're going to keep having a concentrated market.
Yeah, I don't know how to feel about it. I got to be perfectly honest with you, Jim, because there's part of me, it's like, well, it's a little scary and makes me nervous. Because if they don't do well, the market cannot do well because they run the market. But on the other hand, I'm like, well, to your point, they've been doing great. They're the steak on the dinner plate. Who cares how everything else feels?
Let's talk about the two you mentioned. NVIDIA, every single hyperscaler came out of second quarter earnings, raising their CapEx expectations for the next year. That gravy train's not going to end anytime soon. And then you look at Microsoft, and the magic of Microsoft is what ChatGPT and OpenAI is spending on Microsoft is huge, driving the Azure growth. But here's what I think is underappreciated, is the benefits that Microsoft is getting on the cost side from AI are huge. Their headcount is down year over year. Who can grow at 15% a year with fewer heads? Not that many companies, and that's the magic of what
So you think
Microsoft
the
has.
spending on AI, and I know this is not great for the jobs market. That's a separate conversation. We're talking about the stock market right now. The spending on AI, not just Microsoft, but everybody, may supersede some of what you're talking about, the labor costs. So it may seem like a net spend, but it might just fall to the bottom line.
The market, and we have been worried about what's the return on AI. A year ago, we didn't see the return on AI. Today, you're seeing that, and Microsoft is the prime example of that.
Why aren't we talking more on this network, and myself included, about tariffs?
The tariffs are a sensitive topic.
Well, crush the market. I don't need to remind you, was probably a few sleepless weeks. In early April, quote, Liberation Day, with the higher than expected tariffs, the markets got obliterated. We lost 20% in a matter of days. We've not only gained all of that back, but more.
The tariffs have been pushed out, so that has helped. People built inventory, so that's helped. And they haven't been implemented to a wide scale. We're seeing small bits of it in the CPI data. There has to be more over time. When you look at the margin structure of importers, they just don't have enough margin dollars to cover the tariffs. So ultimately, they'll come through.
The other side of that, and I don't want to go into some deep dive on tariffs, is that the stuff that's going to be tariffed is only about 12% of what we buy. Most of what we do in America are services that's largely untariffs. Yale just had a study where tariffs will add about 1.5% to consumer prices. Listen, Jim, we've had massive inflation the last 4 or 5 years coming off of COVID and stimulus and all this other stuff. Is 1.5% enough to hurt corporate earnings power, or can we get through that?
That's a very important point, which is the 1.5 in aggregate is not a problem, but the companies that have a tariff issue, it's not 1.5 to the cost of their product. It's 10 or 15 or 20%. And so the companies that have pricing power or don't have the tariff issue are better positioned than those that have it, and we're going to see that play out in the second half of this year.
Okay.